Imagine investing in a mutual fund that gives 12% annual returns for 20 years and still ending up with returns closer to 5%. Sounds impossible, right? But according to DALBAR-style investor behavior studies, this is exactly what happens to millions of investors worldwide. Not because their funds are bad, but because their behavior silently destroys their wealth. And in 2026, with AI trading alerts, social media panic, and hyper-fast investing apps, this gap is becoming even worse. Let's simplify this with a real-world style example. Meet investor A and investor B. Both invest in the same mutual fund. Same SIP amount, same timeline, same market. The mutual fund itself generates roughly 12% CAGR over 20 years. But here's the difference. Investor A stays invested. Investor B stops SIPs during crashes, buys more after rallies, panic sells during bad news, keeps switching funds every year. After 20 years, Investor A earns close to the full 12%. Investor B ends up around 5 to 6%. Not because the fund failed, because behavior failed. This is called the behavior gap. And it's one of the most expensive invisible taxes in investing. And honestly, this is one of the most expensive invisible taxes in investing. Now here's where things get dangerous. Most investors think investing is about finding the best mutual fund. But investing success is usually less about selecting the perfect fund and more about avoiding destructive behavior. Now we can dive into the invisible thieves. So the first invisible thief is performance chasing. Most investors buy mutual funds the same way people buy fashion trends. Whatever performed best recently attracts the most money. But markets don't work in straight lines. In 2024 and 2025, AI-related and tech-heavy funds massively outperformed. So retail money flooded into those funds near all-time highs. But historically, the best performing category in one cycle often underperforms in the next. This creates a destructive cycle. Investors buy after excitement. Valuations become expensive, corrections happen, panic begins. Money exits at the worst time. Ironically, mutual funds often perform reasonably well over decades, but investors don't stay long enough to experience those returns. This is why many studies show average holding periods shrinking dramatically in the app-based investing era. Investors now react to YouTube thumbnails, Telegram groups, AI-generated stock alerts, daily P&L notifications. The market became faster. Human psychology didn't. The second invisible thief is panic selling. Let's look at history. During the 2008 financial crisis, the COVID crash, and the 2022 rate hike bear market, millions of investors stopped SIPs exactly when future returns are becoming attractive. Here's the cruel irony of investing. The moments that feel the safest usually offer the lowest future returns. And the moments that feel terrifying often create the biggest wealth building opportunities. If you stopped investing in March 2020, you missed one of the fastest recoveries in market history. And this happens repeatedly because humans are wired for survival, not investing. Your brain interprets market crashes like danger. So emotionally, cash feels safe. Investing feels risky. But mathematically, long-term investing during downturns historically improved future returns. Now, here's the 2026 problem nobody talks about enough. Modern investing apps are optimized for engagement, not investor outcomes. Think about this carefully. Every notification, market crashing, this stock is trending, top performing fund today, pushes investors toward action. But wealth is usually built through inactivity. Many investing apps psychologically resemble social media or casinos. Dopamine, constant checking, instant reactions, emotional triggers, and AI-generated recommendations are accelerating this behavior. Investors now feel pressured to constantly optimize portfolios. But over-optimization often destroys compounding. Because every switch creates taxes, emotional errors, timing mistakes, missed recovery periods. Sometimes the best investment decision is simply doing nothing. Now let's talk about the hidden math, the cost nobody calculates, which is the return slippage. Most investors focus on expense ratios, but behavioral slippage is often much larger. Using compound growth, imagine this: a fund compounds at 12%. But due to poor timing decisions, the investor only captures 7%. That 5% gap sounds small, but over 25 years, it becomes massive. 10 lakh rupees at 12% for 25 years, approximately 1.7 crore. 7% for 25 years, approximately 54 lakh. That difference is not market performance. That difference is investor behavior. The invisible thief quietly stole over 1 crore rupee without charging a visible fee. So what will be the action plan? So how do you protect yourself from the behavior gap? Here's a practical framework. 1. Automate investing. Use SIPs and reduce decision-making frequency. 2. Stop watching daily NAVs. Long-term wealth rarely comes from daily monitoring. 3. Create rules before crashes happen. For example, I will continue SIPs unless my income stops. I will rebalance only once a year. 4. Measure time in market, not excitement. The biggest returns usually come after uncertainty. 5. Build a boring portfolio. Boring portfolios often outperform exciting portfolios over decades. The goal is not to look like a genius for 6 months. The goal is to survive long enough for compounding to work. The biggest enemy in investing is usually not inflation, not market crashes, not even bad mutual funds. It's uncontrolled behavior. The market transfers wealth from emotional investors to disciplined investors. So I'm curious, what's the biggest investing mistake you've personally made during a market crash? Comment below. And if you enjoy data-driven investing psychology videos like this, subscribe, because the next video is about why safe investing strategies often become dangerous over time.